So this is chapter 25, part 2. We're just continuing on with our example of differential analysis. So in this case, we were looking at offering up a hotel room at a special rate of $80 when our normal rate is $179. And we did a differential analysis, and we determined that it actually made sense to offer our room up at $80 because we determined that it was better off to have the hotel room occupied, even at the lower rate, than to have the room sit empty. And the reason for this is because we have $50 of fixed costs that we can see here. And by renting the room, we've at least covered an extra $27 of those fixed costs. And so we're better off by renting the room. If we actually look at this, if we think about how this works, we can kind of go back to a previous chapter where we look at selling price equals $80. And if we add up, if we think about these costs here, this is really a variable cost. This is really a variable cost. And this is really a variable cost. If we add all those together, we've got variable costs of $53. And lo and behold, it's our old friend contribution margin. Contribution margin is $27. So here, this is an example of kind of linking these chapters together, but here we're making a contribution margin of $27. As long as contribution margin is positive, then we should take steps to basically sell that additional unit. In other words, every time, in this particular case, each time we rent a room, we're going to generate $27. Just like in the cookie example, every time we sold a cookie, we made $2. Here we're making $27. So we should take the opportunity to sell that hotel room at this lower rate, because even at $80, we're still making an extra $27. So it makes sense here to do that. The other thing we're seeing is that, in fact, fixed costs, so that, before we get to that, so that's kind of what's happening here. If you notice, the items such as insurance and taxes, that's really a fixed cost. That's going to be there regardless of whether the room is rented or not. Here a fixed cost. Here also a fixed cost. You can see that basically the fixed costs have no impact on our differential analysis. And that's because the fixed costs are going to remain constant. And so that's why every time we rent the room, we're making $27. We don't need to factor in any of the change in fixed costs because fixed costs are not changing. Fixed costs are constant. And so they don't impact this analysis. So in terms of the rules that we're going to look at when we do differential analysis, first of all, we're going to, number one, we're going to do the algebra. In other words, we're going to take alternative 2 minus alternative 1. So whatever is in column 2, we're going to subtract column 1 from it. But we have to be careful because, remember, costs are negative. So we have to be careful. We might have a negative minus another negative, which would be a negative minus a minus, which in effect is a negative plus a positive. So you have to be careful when you do the subtraction. For instance, the insurance and taxes, that's a negative 40 minus a minus 40. And algebra would say that's a minus 40 plus a positive 40, and that's what gives you the 0. So that's, we have to be careful to do that. If the differential effect, in other words, here we have a positive 27. If that is positive, we are accepting alternative 2. Okay, so that's the rule. If the end result is positive, we accept alternative 2. And of course, what we just described, fixed costs are irrelevant. We can include them in our analysis, or we could actually exclude them. It wouldn't matter in this case. All we would really need is the revenue and the 3 variable costs. We could exclude the fixed costs entirely from this analysis, and it wouldn't change. We would still have the total. Now, the one thing to be careful about is that obviously we can't offer every room every day at $80 because then we would lose money. But if we're talking one incremental room that's either going to be empty or be filled, we'd rather do that. We'd rather fill it even if it's at the $80. But we have to be very careful that we don't have everyone just waiting for that $80 room, and that everyone starts, that pretty soon all of our rooms are only rented at $80. So usually hotel chains, airlines, people like that, they only offer up a certain number of rooms to these online brokers, and then the rest of the rooms are at regular rates, and usually, those are for business travelers, etc. But they will offer only a limited supply of hotel rooms at these special rates because they don't want to jeopardize their regular rates. But when it comes time to filling a few extra rooms, then it makes sense to do that. So we're going to continue on with another example using differential analysis. And this one would be one that would be a little more practical for a business. Here we're going to consider replacing an old machine with a new machine. And the reason here would be that the new machine is more efficient and more cost effective to operate. Obviously, sometimes equipment would need to be replaced for other reasons, for instance, safety, environmental reasons, or perhaps it simply just breaks down. It needs to be, a new piece of equipment needs to be put in place. But in this particular case, we do have an option. We can either keep the old machine or we can replace it with a new machine. And so those are our two alternatives. We're going to have alternative one. We're going to have keep the old machine. Alternative two, replace it with a new machine. So here's some information on the old machine. It cost $50,000. It has accumulated depreciation of $20,000. It has a remaining useful life of 4 years. The operating costs per year, excluding depreciation, are $35,000. And the value of this old equipment, if we were to sell it, in the event we replace it with a new machine, we can get $11,000 for that old piece of equipment. Now, the new machine is going to cost us $70,000. It has a life of 4 years, so we're talking about the same remaining life for both machines. We're talking about a 4-year time horizon, and that's important because it makes the analysis easy. If those lives were different, then we'd have to modify our analysis so that we would incorporate any investment or some other way of equating those two together. But we're not going to get into that. It's kind of beyond the scope of what we're trying to do at this point. And the operating costs of running this machine is $20,000 a year. So you can see considerably cheaper a year, $15,000 a year cheaper. That's obviously why we would be interested in doing this. Okay, so we set up our table below, our differential analysis table. Alternative one, again, is to keep the old machine. Alternative two is to replace it. And we're going to look at the differential effect of selecting alternative two. So again, we're going to do the math. We're going to take column 2 and subtract column 1. All right, so first thing we're going to do is we're going to look at any revenue. Now, if we keep the old machine, we're not going to really do much other than we're going to continue on with what we're doing. If we replace the old machine, so alternative 2, then we are selling the old machine, so we would have some revenue. And then, of course, we have to go ahead and purchase the new machine, so then we have a cost. And then in both situations, we have the difference in operating costs, which is what we want to capture in our analysis, because that's why we are really wanting to do this. So the first question is, under the old machine, do we care about the cost and the accumulated depreciation of the old machine? And the answer, for purposes of this course, is no. These are what are termed sunk costs. And these are costs that have been incurred prior to this decision point, and therefore are completely irrelevant in this decision. So it doesn't matter what we had paid for the old machine and how much we've depreciated. The point is, we're going from today forward. All that matters is how much can we get when we sell that machine today, and then how much do we have to pay for the new machine to replace it. And then we're going to look at the cost of operating those machines. But we could have paid $1 million, we could have paid $1 billion. It doesn't really matter. That happened in the past. There's nothing we can do about that now. That's not really part of our decision now. That decision was already made in the past. It is completely irrelevant. So sunk costs are irrelevant. So that information is completely irrelevant in this case. Okay, so in terms of revenue then, really all we have in terms of revenue is the sale of the old machine. And again, that is under alternative 2. Alternative 1, we're going to keep the old machine, so we're certainly not selling it. In alternative 2, we are selling the old machine, and so we would be receiving $11,000. And so the differential effect there is $11,000, and again, that's positive. In terms of costs, again, in alternative 1, we're keeping the old machine. We don't have to buy another machine. In alternative 2, we have to purchase the new machine, and that's going to cost us $70,000. So negative 70 minus 0, negative 70,000. Then we want to factor in the operating costs, because again, that's really why we're doing this. But we want all 4 years to be included in this analysis. So what we want to do is take each one of these times 4 years and use those figures in our analysis. So the old machine was $35,000 a year times 4 years. That's $140,000 it would have cost us to operate that machine. The new machine is $20,000 times 4 years, so we would only require $80,000 of costs. Now these might be, for instance, direct labor costs. Maybe the new machine allows us to eliminate an additional person, or just reduces the direct labor hours, and that would be obviously a cost saving. So we're going to take minus 80 minus minus 140, or minus 80 plus a positive 140, and so that's going to give us a positive 60. So if we just add these up, and again, the other amounts, that encompasses everything. We've taken this, the operating costs into effect, the sale value, and the purchase price. The cost and depreciation, accumulated depreciation under the old equipment, are irrelevant. So here we have 140 negative, keeping the old machine. Here we have 139 with the new machine. And if we add this up, we have a positive $1,000. And because that's positive, we would accept alternative 2. And so we would replace the equipment. Now, just before we run out of time, quick analysis. Is the $1,000 worth doing this? What if we took the amount that we would have to spend, the $70,000, less the $11,000 we'd get by selling the old equipment, $59,000. We invested that at 2% over 4 years. We'd get even more money than the $1,000. $1,000 doesn't seem like it's really worth it.